And we are back. Guys, everything has hit the fan. We got war. We got the tech wreck. We got the Bitcoin standoff. We got the stock market that's trying to make up its mind. It's been a chop fest for over a quarter. And the weirdest thing is, I'm in bed right now. We're in the Airstream traveling. We're on a Starlink upload, so hopefully it doesn't break up too much. But I am absolutely exhausted. I've been doing the open claw stuff for at least 10 to 12 hours a day. I'm exhausted trying to keep up with the markets and build systems and all this stuff. There's a lot to talk about. But yeah, let's call this episode Everything, Every Shit Has Hit the Fan.
Yeah, Chris has talked to his AI agent a lot more than he's talked to me in the past week. So he is I can confirm he's very tired. He's been working real hard on his AI.
It's been fun. It's been a real cool journey to see like what's possible now, and there's a ton of hype around the OpenClaw stuff and just all the agentic stuff. It's like every program from the LLM companies to software companies like Notion. Everybody's trying to do their own integrated agents now, and so it's kind of a race to see who can capture the hearts and minds of these users. But there's a lot of hype. There's a lot of like overblown stuff that people think these can do that is not quite as easy as a lot of the influencers make it seem like. But I think, things are only going to exponentially get better from here. And the use cases that I've implemented are already helping me in so many areas in my life. So we can talk about that. But Trav, what have you been up to, bud?
Man, been in the thick of the SaaS apocalypse, the thick of the AI wars, trying to figure out, how to survive in a increasingly exponential changing world. So you could say, yeah, things are just real rosy and chill over here. Or the opposite of that, actually. No, it's been
Yeah.
good, man. Stock market's been wild. We've been through earnings season, SaaS apocalypse, lots of bifurcation between sectors, lots of big moves, lots of portfolio moves. And yeah, it's just been a very busy season. So I'm just trying to make the best investing decisions and help our community members out through all of it.
Yeah, we'll get into the charts, but I guess just at a high level, like what are the major themes? Obviously, over this past weekend, the U.S. attacked Iran, and things are explosive over there, no pun intended. And what I thought was interesting was how Bitcoin actually held up as some equities and even gold pulled back. We saw Bitcoin actually hold up quite well, and if anything, put in a little bit of a short squeeze. Obviously, oil is up quite a bit over the weekend. We can talk about what the situation looks like there. But after 7 or 8 green months in a row for gold, it's pulling back this week, but it's still not crystal clear if the parabolic run is over. But I'm looking for early signs that there's capital rotation from gold to Bitcoin. I don't think there's a super strong case that it has to work that way, but I'm looking for evidence that it is. And yeah, market sentiment just seems quite bearish out there. Talking about AI tools, I've been creating some ways to ingest massive amount of information to come up with I guess, a better read of the fear and greed indicator. It's one thing when prices are down, the fear indicators show extreme readings, but what I'm trying to dial in is like how many contrarians are out there, and is this midway through a quote unquote bear market, or is this a quick capitulation for a V bottom from here? That's just where my head's been at. But also the stock side hasn't really been helping us because stocks have been dead flat except for large cap tech and SaaS. That's obviously down quite a bit. We can look at what is it, IGV, the ETF that
Yeah.
tracks software, which is down. It was down, I think, close to 20% from the all-time high, where the S&P and the NASDAQ are only still a few points off of all-time highs. So yeah, we're seeing capital shift. What else are you guys noticing at a high level?
Yeah, I mean, there's been a lot of minefields, and like I said, I mentioned earlier, just sectors. There's been a huge shift in sectors in terms of performance. Like it started the year with a pretty dramatic shift into the whole atoms over bits phenomenon, right? So material stocks, AI infrastructure stocks, the metals and mining stocks, of course, and then on the flip side, you had SaaS getting hit, financial services getting hit, anything that was even remotely potentially going to get disrupted by AI. You know, not even evidence that it is getting disrupted, but just like what happens if, right? And there were stocks like Thomson Reuters that sold off in a hurry. There were stocks like C.H. Robinson, a trucking brokerage company that sold off. You know, they're just things getting shot. You know, before we'd even seen any actual impact from AI. And so, like it was like every other day, Anthropic would create some new release that was half baked, and yet it would cause a whole sector to sell off. And so, yeah, I mean, it was really interesting to see people that were, you know, just rapidly shifting out of certain sectors in tech and certain companies that might be threatened long term, maybe or maybe not, right? And then piling into stuff that was getting parabolic, you know, metals and mining, semiconductors, and particularly like the memory stocks. I mean, the Kospi index, you know, it's funny, right? Because like there's two stocks that make up half of the Kospi, half of the South Korean market. It's Samsung and SK Hynix, and they were going parabolic. And then just in the last like week or two, you've had a massive momentum unwind. And so what started the year with atoms over bits now looks like it's kind of unwinding a little bit, at least short term. So there's just been massive moves. We through earnings season, we also saw a lot of stocks that like put up pretty solid numbers, and you could almost like put up, you know, any type of good numbers, and still your stock would sell off the next day unless you like guided to like some sort of crazy high guidance. We had Nvidia that reported amazing numbers, guided to another incredible year of growth, and the stock was down afterward, right? So there's just been a lot of strange action and just a lot of like whipsaw price action in stocks. And it's funny because when you look at the overall indices, you don't necessarily get the sense of it. You don't get the full sense of it unless you're looking underneath at some of the individual stocks and individual sectors. And just a lot of strange things happening. I think a lot of what's happening is momentum certainly is part of it. Flows and sentiment are all getting very concentrated. Like, you know, you think about like even things like Bitcoin and SaaS have been highly correlated, right? And they've both been bouncing here in the past week or two, despite all the geopolitical stuff happening. So there's clearly some very strange and volatile things happening underneath the surface, even though you might not be able to see it looking at the overall market index.
Yeah, so back in January, you wrote in the Escape Velocity Investor newsletter that rumors of software's death have been greatly exaggerated. And I know you've been buying some of these software stocks. Has your thesis changed at all? And if no, why not? And if so, how? And are you still bullish on some of the legacy companies, or do you think that there is going to be like a mass death of some of these leaders in the software space?
Yeah. I mean, I definitely had to question my thesis as I was getting blasted on all these falling knives in the month of February. I knew a lot of it was probably overblown, and obviously we still have to see things play out over the next couple of years. But the way I see it is very much still in line with the article that I wrote back in late January, which is there are going to be software companies that get killed, like a lot of the smaller point solutions. You know, I use Trello as an example, which is kind of a funny, silly example, but you know, it's very easy to build something like that. And there are a lot of products you could imagine that get easily disrupted by home-built, homegrown tools, or companies deciding to build stuff in-house, or even just AI native tools that are you know, there's a lot of startups out there that are building like fresh takes on a given software platform that are AI first. And so that is absolutely going to happen. And like, I think it's very clear with the jumps that we've seen in coding capabilities over the last few months from Anthropic and OpenAI that yes, there is more competition than ever now hitting the SaaS sector. However, I still think that there are some legacy or some incumbent companies that actually will be better off and grow more in the next 3 to 5 years because of AI, and will actually end up on the winning end of that. And so, you know, the whole sector has been treated as one trade. But I think ultimately there are going to be winners and losers that play out in 3 to 5 years. And so I think that's what I've been trying to do, is try to find the ones where I think they're less likely to get disrupted because they have a data advantage, proprietary data, right? Or they're such a deep system of record, like think about like a Workday or a ServiceNow,
Service
something like
now.
that. Yeah, exactly. Like
Yeah.
large enterprises are very unlikely to try to do that themselves. Other smaller competitors are not going to be able to compete with the scale of those platforms. In the meantime, all of those companies are actually building in all these AI agents and AI features on top, and so they're going to ultimately be the ones in the best position to actually earn more revenues from those things, not less. So, I do think. There's a lot of opportunity in some of the stocks that got hit the hardest, and there's still a lot of unknowns though, for sure. Like I have not figured it all out, and I've got some guesses and made some portfolio moves, but yeah, there's still obviously a lot that can change into how this evolves.
Let's talk about like Block and some of those examples. Over the
Mm,
past week, Jack Dorsey laid off, what was it, 4,000 people, and
Yeah.
basically blamed AI. And some people were like, no, you're just doing it because your stock is in the dumps, or it's really not that great of a business. And I don't know, we saw the debate, kind of going back and forth. And what was interesting was, and not really surprising, but just kind of interesting to see, is the stock was actually up quite a bit on that news. Right, we saw a pretty big gap up, and then it's holding up throughout this week. When you zoom out, you can see that block ticker XYZ has been in an accumulation range since 2022, after falling quite a bit from its all-time high up, just below 300. And so, yeah, what do you guys make of this? This specifically, is this an outlier, or is this a bellwether for things to come in the future? And was Jack rational in doing
mm.
this, or did he just do it to kind of make himself look better? What do you guys think?
Yeah, it was a pretty
I do.
shocking headline. Yeah, go ahead, Nick.
I
Let me
was
hear
going
your
to say,
thoughts.
I do think that the way XYZ reacted after earnings is just a sign that being in the investor class is becoming more and more important, as, investors are going to reward these companies that can improve margins and have the financials look better. So, I think it was like a 20% plus pop in XYZ. So, uh, I think we're going to probably see a lot more of this going forward. And I know it was a topic of the importance of getting invested and being invested. And I think that this just proves that. But Trav, go ahead. I didn't think that the earnings were, I didn't think XYZ was doing too bad. And as far as the company goes, I think they had a lot of bloat as it was, but you can take it from there.
Yeah, I mean, I think it's going to ultimately end up being a little bit more of an outlier. I think between a 40 to 50% cut in the workforce is not something that we're going to see broadly, at least given the facts that we know now from most companies. There is a risk here, though, that I think there are probably a lot of companies, particularly in tech, particularly in software, that may need to do like 5 to 10% layoff rounds. And that, of course, when you get a lot of those happening at once, that can create that like snowball down the hill of like unemployment rises, hits consumer spending, hits business confidence, and then all of a sudden you're in a recession. And so we're watching the unemployment metrics very closely, and all the headlines about layoffs and things like that to try to see if that's what's occurring. But Block, for a couple of reasons, right? They like doubled their employee base from like 2020, in the post-COVID period. There's a lot of bloat there. Jack Dorsey's known for running fairly bloated companies ever since Twitter. Certainly Block, they had made that huge Afterpay acquisition. A lot of that hasn't quite paid off, and so yeah, there's a lot of fat there probably still to be cut, or that needed to get cut. Now the way it was done was shocking. Like the 40 to 50% headcount cut at once is a very shocking way to do it. And they said, that a big part of that was because they wanted to get in front of it. They didn't want to do a lot of small cuts, and they see AI as this threat. I think Jack Dorsey's probably overreacting a little bit to this like AI theme or AI threat. But we could see some other companies do pretty heavy layoffs. But I do think they're going to end up being, in terms of the overall size of the workforce cut, I think they're going to be one of those outliers. And yeah, but I mean, ultimately, it's good for Block. I actually have owned Block stock since last year when it gapped down and sold off. And it's only good for margins when you lay off 40% of your staff, assuming you can still hold growth. And so, yeah, I mean, they're going to end up earning a lot more this year than they did last year. So on a micro level, that's good for Block. But again, on an economy wide level, if you started to see a lot of layoffs, then ultimately that's going to hit the demand side of the economy at some point, and that would be a negative. But 40% cuts, knock on wood. I hope we don't see that, happening a lot. I think we're going to see Block be an outlier there.
I think
Yeah, I've
Goldman
been
Sachs just announced cuts too. We've been seeing a lot of announcements here and there with job cuts. So
yeah,
that's
there's
definitely
a few Twitter accounts that are tracking layoffs, and yeah, I know I've been ingesting that into my OpenClaw, trying to like find signal throughout noise and hype, and
Well,
it's
yeah, let
something
me give you a
definitely to
quick
pick.
a quick perspective on it too. For like reading through a lot of earnings calls, like I think what's clear is that companies actually are trying to make room in their spending budgets for AI tools and AI products and testing out AI and adding new AI features. And as you know, like using OpenClaw, like you can run up an API bill pretty fast. And you imagine that on an enterprise-wide scale, investing in AI can become very, very expensive for an enterprise. And so a lot of companies are trying to figure out how do we open up space in the budget for that. And so ultimately, yeah, they're probably looking at some of the bloat in the middle management ranks or some areas of headcount going, well, maybe if we can shift headcount, either lay people off and invest in tools or keep the same size staff, but then, try to, as we grow, use the earnings growth to fund more AI investment, that's kind of the rational decision from a lot of like company execs. And so, yeah, I mean, I think they're all trying to figure out how do we make that AI investment? And so that money has to come from somewhere. So I do think like a lot of companies are probably either trying to keep headcount flat and do more with AI or even cut a little bit so that they can open up more AI investment.
Good point. Nick, you had a tweet that I wanted to pull up here, just talking about like the rotation out of large cap into small cap. You were saying that FactSet is basically printing a price target at 20% above today's levels, and fundamentals were looking good with the bottom 493 stocks contributing more earnings and pulling weight. Like, is this just a short-term trend, or is this like a meaningful shift? We have been focused on the Russell, which, basically in January, it was actually outperforming the NASDAQ. Now it's kind of flat with the S&P and the NASDAQ. But yeah, what else do you want to say about that?
Yeah, so a 20%, the S&P 20% from here, it's I don't want to say it's hard to imagine right now, but it's definitely a cloudy picture. So and the price action in the S&P 500 has kind of been saying we don't know what the hell we're doing, right? The bulls and the bears have been battling this out. But when you actually dig into the latest, earnings data, the fundamentals, it things are looking pretty good. We're expecting about 14% earnings growth for 2026. Very healthy earnings growth considering. Of course, there's a lot of things shifting and changing this year that we don't know what unemployment's going to look like and if that's going to really eat into some of that growth. But so far, so good. And a lot of people are wondering, how is the S&P 500 up still while all of these companies are floundering? You had companies like ServiceNow, Salesforce, Intuit. I mean, a lot of these software companies that have, I mean, even Amazon was down, Microsoft is down. These are Mag 7 stocks, huge market caps. And for somehow, some way, the S&P 500 is still just shy of all-time highs. So what gives is kind of the big question mark. And I think it's the bottom 493. I think that the construction of the index right now, even with all the concentration in the top 10, the top 10 stocks are about roughly 40%, in terms of the S&P, and somehow, some way, we're still up. And I think it's that bottom 493 pulling its weight. And you can see that in the earnings growth that the 493 is catching up in contributions. So I think that's why things are holding up. Is it going to continue? I think the Mag 7 people could start looking at dip buys in some of these names soon. Your Microsofts, your Amazons, maybe even your Teslas. If people start dip buying those, well, and the 493 continues to hold its ground, I can see a case all-time highs and heading higher from here in the S&P 500. So that's kind of what I don't think that the price targets are that crazy. I think it's very possible that the pain trade could be to the upside in the S&P because of all that.
Yeah, one thing I also wanted to point out, and I think you've been kind of tweeting about this and talking to people about this a lot recently, is like just how like good an index fund actually is at keeping you in the game. And like for anybody listening to the audio, this was you responding to a tweet where somebody said, "I've never met a serious investor that only invests in index funds." And you said that that obviously misses the mark. It's about risk appetite and somebody who wants to put in the effort for outsized returns. But like one of the huge benefits to index funds is like if the mag 7 or if a huge area of the market gets hammered, like that just keeps you protected in a certain way. And yeah, I don't know, do you want to expand on that? Because I thought that was just a really good point. And like it's so
Yeah.
simple that it sounds like okay, it's too simple to really matter, but it actually matters a lot.
I actually think that the index is really proving itself right now, personally. And I think that with the structure of an index, right, you've got the companies changing throughout the index depending on, throughout the decades, what technology is doing, which companies are winning, which companies are losing, and companies are rotating in and out. And that is a feature, not a bug. That's why I love index investing during uncertain times. Of course, your whole entire the argument this person was making was the only serious investors are investors that are trying to beat the market. Trav, maybe you could speak to this and what if you agree or disagree with that, because you are an active investor. But I think even you own some index funds, right? Like,
Not very much, but
not
I'm a
very
pretty
much.
unique I'm a pretty unique case, yeah. But no, I think you're right that like most people don't have the time or the skill set to sit there and be active investors and successfully beat the market, right? And so like and index funds actually have a pretty solid record long term, beating inflation, and certainly in the last decade have had a great track record. And you just mentioned too, they're kind of the indices are showing their worth right now with the heavyweights are not performing, but the rest of the 493 are not only performing price wise, but they're actually growing earnings at a high clip. And so yeah, like it's like they're picking up the slack, so to speak. And a couple of reasons for that.
Mhm.
One, we actually have a pretty decent U.S. economy and global economy, at least before all the war started. You have the Mag 7 investing 600 billion in AI this year, which is 2% of GDP. You have government still running deficits. There's a lot of like structural reasons why like the economy is still holding up and demand still holding up, and unemployment remains still low despite all the scares we talked about just a few minutes ago. Like unemployment rates still remain low, and actually jobs are doing okay in aggregate. So yeah, I mean it's I do think we still have a good possibility for at least a 10 or 15% correction in the indices this year. One, because of technicals, some of them are breaking down. Two, because of geopolitical uncertainties. Three, spiking oil prices and yields can always upset things in the short run. So like, I think we're going to get some of these worries that coalesce, and we're going to end up with a 10 or 15% correction in the indices at some point this year. And so that'll be a nice opportunity to add to some stuff. And us active investors will just have to ride through it and make good decisions and have some dry powder on hand. But yeah, I think it's been pretty good to see like the indices holding up fairly well despite all the stuff that's been happening.
Yeah, and I
Can
don't think it's about being serious or not serious as an investor, right? Like that's the point of the tweet, is it's more about risk appetite and effort. Because Trav, it's you got to put in the effort. You have to have the skill set to be able to pick stocks, and not everybody can do that, but that doesn't make them not serious investors at the
Totally.
same
Yeah,
time.
active or passive, if you're investing, you're ahead of a majority of the world. And something
Mhm.
I've been thinking about, I have a prediction that I want to kind of share with you guys. I don't know if you agree or disagree fully, but like I've really been thinking a lot about the employment situation. And, yeah, the unemployment rate is what, 4.3 right now. And I think there is a big shock coming. Like my guess is that it's going to be later this year when layoffs really accelerate. I mean, we're just now seeing what AI agents can really do. And like again, there today they are the dumbest that they're ever going to be. They're only getting smarter from here, and they're getting smarter at a very, very rapid clip. It was like a couple days ago that ChatGPT came out with what was it 5.3, and then today they just launched 5.4, and the model race is on and everybody's doing the agents. Like I think it's going to take a couple quarters to like really ripple through the white collar work, but dude, I think the layoffs are going to get pretty gnarly, and I think that's going to have a ripple effect. Now, how does it affect stocks, right? The economy and the stock market are two totally different things. I think stocks are actually going to benefit from it. Just like we saw with Block, like if companies are laying off and they're increasing their profit by, maybe seven figures per fired employee, the market's going to like that, but that's going to create again a further bifurcation between the investor class and the working class. And so, Nick, I know you said this earlier, and I think this is a point worth driving home. Like in the age of this AI with a lot of layoffs, your armor to that is your investment portfolio. That's what's going to get you through if you do get laid off or if there is less opportunity. But I don't know. I don't want to make a prediction on like an unemployment number, but I do think it's going to keep going up throughout this year and into 2027. Do you guys agree or disagree, or what do you think?
Oh man, I think I agree with the unemployment rate probably goes up short run. I think I kind of disagree. Like, I think if you get a high enough rise in the unemployment rate, like the stock market is not going to be saved. Like, again, I think a small amount of companies cutting headcount to improve margins works, but when you get a broader set of layoffs, eventually that is large enough to actually hit consumer demand and business demand, and so I don't think beyond a certain point the stock market can continue to perform well if the overall economy doesn't perform well. So that's where I think there's a little bit of a disconnect. Like I guess what I could say is I kind of disagree with this idea that there's going to be a permanent underclass and and these people that are like these small group of people that own all the AI and own all the intelligence are going to, I mean, you think about like Anthropic, like their numbers look great right now, but how are companies going to find the dollars to spend on AI if there's no consumers that are consuming, right? So like you take it to the extreme and you can kind of see like the logical fallacy there, but I do think there's going to be a lot. I'm optimistic about like there being a lot of new types of jobs eventually created, and you think about like agents. Like agents are kind of like really really smart junior employees, and they'll probably get as smart as like really really smart senior employees, and so you kind of have this like almost infinite pool of labor that's entering the labor market, and so the question is like, what does that do? And it definitely is going to affect like entry level hiring. I think we're already seeing that in the numbers. It's definitely going to end up with some layoffs. We just don't know exactly what level. But then ultimately, it's also going to lead to a lot more capabilities, which I think when you look at the medium and longer term is going to grow the global economy a lot. So like the problem is the path between here and there is like really, really uncertain. But yeah, I think like ultimately I'm still kind of optimistic on the long term, but I don't think the stock market is going to be smooth sailing if we do get a like say a 7, 8, 9% unemployment rate.
Yeah, I agree with you there. And I guess, the risk is we get a billion agents that are eye level at all the white collar jobs, and humans just can't do those jobs anymore. The other thing that I think could be a white swan scenario is we get billion of agents that participate as kind of pseudo consumers, where
Mm-hmm.
like an economy pops up around these AI agents. I mean, we're already seeing examples of this. There was a guy here in Austin that launched his own AI agent that started building in public and has made six figures in crypto. And, with Coinbase's new, what is it, X402,
Mm-hmm.
where, you're going to, this isn't new per se, but the concept is getting more available of like micro payments and things. So I have an agent that I hooked up with a wallet and I'm doing some testing behind the scenes with. And so there could be this whole new economy with billions of new people or souls or whatever you want to call them that are creating an economy that we can't really quantify right now. I think Raul Paul was talking about this, and um, So that I guess is on the growth side of the equation. It's like, yeah, we might have a lot of unemployment, but then we could have a whole new economy that gets developed because of these agents. Maybe it replaces part of the decrease in productivity. I don't know. It is a very weird thing to think about, and it could go so many different ways. And we had the big Citrini article that came out. Well, it turns out they were short, so that was kind of a biased article. And we saw counterpoints to that article. Which, by the way, I mean, I don't know. Where do you think we are with that argument, Trav? I think you've read some books and you've actually kind of come up with some good theses on that side of the equation.
Yeah, I mean, yeah, I was kind of talking through some of those angles, earlier with like the idea that if you get 10% unemployment, um, you know, the idea that you're going to still have like parts of the stock market just still flying, or like the rich people are still going to be like gaining wealth. I think I don't know. There's some sort of like logical fallacy there. And yeah, again, but I'm more with what you were saying a minute ago about like agents creating a whole new like opportunity for people to like sell products to agents, or for new like types of jobs or new skills to sort of like that agents themselves will consume and pay for, and so like those are the kinds of things like most people aren't yet thinking about. That's the kind of thing that the Citrini piece didn't even address, right? Like what are the second, third order effects that people like can't see today? They just see the doomer side of things. And Citrini, I've followed them. I've been a subscriber for like a couple years now, and they've had some really great thematic macro calls. They were early to the AI theme, and they've done a lot of the like really interesting like picks within AI and AI hardware. So they're not like total doomers, but there's some things with that research publication that I find a little off-putting as well. Like the way they run that organization is not I wouldn't do some of the things that they do, let's say. But they're generally relatively like thoughtful and smart, and I don't know if they meant to necessarily cause like a panic with that article. They were trying to be like more of a thought experiment, like think ahead 2 years, what happens. And yeah, I wish I could say like I had the crystal ball for like 2 years from now, but things are changing so fast that there's going to be some frictions in between. Like I do think we're going to see like more, certainly more financial market volatility, but then also like more economic volatility perhaps as well, short run. But then medium to long run is where I think ultimately like human desires just expand to fill, fill the world. And like these agents are only going to end up giving us more capabilities and more things that we're going to want to do as a species, right? And so, and there's a lot of things like, that AI exists in the digital world to do, but there's a lot of physical things that still can't be done, or physical jobs that can't be taken over, right? That are still going to need to be done for a long time by humans, until apparently
Yeah,
all the
the robots
Tesla
are probably
bots.
what, 5 or 10, yeah, maybe 5 years away, and
Yeah.
then the plumbers and electricians will get disrupted, and then we're all screwed.
Yeah.
And someone has to fix the robots, and someone has to be able to control the Waymo cars when it screws up. And
Well, do they,
there's
or
going
do
to
the
be like,
robots
there's
fix the
going to be
robots?
call centers. Well, shit. Yeah. I don't know. It's mind bending trying to process it and make a
Mhm.
prediction. I keep going back to, man, the boomers really did it right. They had a booming stock market, booming bond bull market, and they just
They
retired
bought
and got
their
out. And they don't have to deal with any of this.
they bought their house for the cost of a potato and selling it for millions of dollars.
Exactly, like they kind of nailed it, and now they don't
Leaving
have
us
to deal with
millennials,
what
yeah.
they're
There's
gonna do for work.
there's a great tech book. I don't even know, or sci-fi book. I don't even know if I'd call it a book. It's more of like a kind of a long essay. It's called Manna, Manna, and it's a really, I think it was written in the last couple of years, but it's a really interesting insight into like what a far off future with lots of AI and cheap AI looks like. And there's sort of like the dystopian view that it presents at the beginning of the book, and then you see a more optimistic view as the book like goes on. And I think it's a really interesting like it doesn't really tell you the answer whether it's going to be the dystopian version or the optimistic version, but it kind of gives you
Mhm.
the how both sides could look, how those societies could evolve. And so I definitely recommend it for anybody who's like interested in the topic of like what does a future look like with a ton of robots and cheap AI and self-replicating or self-improving AI.
Cool. Yeah, we'll have to check that out. You guys want to do like a quick chart run through and then get to some questions?
Yeah.
All right, Nick, I'll do the charts and then you cue the questions up for us if you don't mind.
10-4.
So, all right, let's jump into gold. So this is kind of the big chart that a lot of people have been watching, and depending on if you're looking at futures or GLD, ETF, or spot, I mean it's either 7 or 8 green months in a row, and we have not taken out the January pivot high yet. So we had the parabolic run and pullback, and this is the monthly chart for you guys that are watching the video. And the daily chart has been a little tough because we had the parabolic rip into January, we had the crash, and it's kind of been stair stepping up, but it's still below the prior all time high. I think we are very close to a high here. It's just so overextended, and when you look back at historical runs, I mean, this is such an out of the ordinary move, and I'm seeing the narrative, which is the fiat money is broken, which it is, but because of that, gold's just going to keep running forever. I'm seeing the new paradigm posts, kind of like we see during parabolic rips in Bitcoin. So I do think we're close to a top here, and if we start to pull back in March and Bitcoin starts to come out of its slumber, that's where I think that rotation narrative could really kick in. Is this the low for Bitcoin? I don't know. It's odds are I think that we go lower. This is definitely not a the depths of a bear market yet that we've seen in prior market cycles, but this 5 month slide where we were basically down 50% in this leg, it got overextended in the short run, which is why we're seeing a bounce right now. And basically, my two plans are either, and actually, this is what I said the other day. This was March 2nd. So, yeah, earlier in the week, I said, the fact that Bitcoin didn't wash out during the weekend Iran conflict says that buyers are holding the line. I think in the short run, the highest probability thing here is that we try to close the gap around 84K, the CME futures gap. And that's actually what happened this week. Actually, yesterday is we saw the breakup above that 70K resistance, but we have a whole lot of overhead moving average resistance. And it's just very, very dangerous to try to buy like a quote unquote breakout in bearish price structure. So I'm not buying here. I have part of my short hedge on. And if we get back below 60K, and we go into a deeper bear market like we've seen in prior market cycles, I'm going to start dollar cost averaging. And for the community, I built a DCA strategy. And what I typically like to do is dollar cost average when price is more than 50% below all time highs. We bounced off of that level last month. And now it's kind of a wait and see game. I feel like we're kind of in purgatory here. It's like, are we going to get these low stink prices to put in some stink bid orders in back in the 40 to 50K range? Or I think the pain trade is to the upside. So do we get some kind of catalyst? Maybe it's gold pulling back. Maybe it's the Iran conflict figures itself out in the next few weeks. Maybe it's, some kind of white swan that we can't predict yet that sends Bitcoin really ripping the faces off of shorts, and then puts in a dramatic shift from extreme fear to extreme FOMO again in Bitcoin. If that happens, cool. I'll start taking bull market setups. But right now, I'm not doing much. I'm just holding part of my short hedge, which has been a nice way to raise cash on the way down, and just kind of waiting. But again, stock indices haven't been much help. Just take a look here again. We are basically dead flat from October in most of the stock indices. As we know, if we look at like NY Fang, so if we look at, basically Mag 7 plus, whatever we're calling this, you can see that there was about a 19 or 20% sell off there. A little bit of a bounce this week along with Bitcoin. But yeah, that's about it. I guess gold, Bitcoin, and the indices are kind of the main thing that I've been watching. Obviously, the big unknown is on the oil side, right, we saw over the weekend with the attack, oil started to rip, and it's up quite big. It's actually back to levels from early 2025. Um, are you guys seeing any implications from this? Obviously, the higher price goes, the more it affects just general inflation. But anything you're seeing there or think we should point out on the energy side of the equation?
This is one of my questions for you guys, actually. So let's just
Yeah,
go
jump
right
into
into
it.
that question. If oil goes above 120 and stays there, what does that actually do to S&P earnings estimates? Does it kill the soft landing thesis? I don't know. I think it's more like a no landing thesis, right? But yeah, what do higher oil prices do to the stock market and the economy?
It's not
Trav, you want to
good.
take this one?
It's not good news.
Yeah.
um,
There goes your
yeah,
rate cuts.
yeah, exactly. No, I think yeah, we're already seeing yields get pressured up a little bit, up about 20 basis points off the local bottom here in the last couple weeks, and so that has a flow through to credit performance. It has a flow through to the rates of people that people can borrow at. It has the potential to just affect a bunch of sectors from home building, et cetera. So like yeah, I mean, it's oil being, especially if it's like, 100 plus, 120 plus in a short amount of time, you're going to have some cost pass throughs from, companies that actually produce stuff, and transportation and things like that, So, yeah, I mean, there's like economic papers out there that kind of show like how the dispersion of oil prices works throughout an economy. It takes a while, right? It can take like 6 to 18 months, but eventually, like, it ends up showing up in CPI, and you can get in a like price cycle again where companies start having to raise prices, and that leads to higher prices, and it's just everything that we just saw from 2022 through 2024. And
Yep.
so we saw it in the 70s as well. So yeah, I think there is a concern there. However, I think we're a little different than what we saw in the 70s in the sense that North America is producing a lot more crude oil. We've got a lot more gas resources that are being unlocked, LNG facilities. Things can move around the world. Supply can move around the world a lot easier than it could back in the 70s. So the Strait of Hormuz being shut is a problem, but maybe not the level of problem it would have been back then. And so yeah, there's a lot more interconnection that happens, and so I'm a little bit optimistic that we won't see 120 plus for an extended period. Although we could see 100 there in the short run. So yeah, but I expect to see at least some response from producers of shale and players like that. So yeah, I mean ultimately I think we're going to have to see how it plays out. It doesn't look like there's an easy off ramp for the Iran situation at the moment, but things can change quickly in 2 or 3 weeks on this kind of stuff. So yeah, yeah, it would be bad for inflation though. Definitely. Like, I don't think that's good news at all if we see, extended periods of 120 plus crude.
Bad for inflation, bad for rate cuts, bad for higher prices at the pump for consumers, and pretty much in a
And
nutshell.
keep in mind, the Trump administration has been very focused on trying to get rates down. There's a midterm elections coming up in the fall, so they're fairly incentivized to try to make sure we don't get 120 plus crude oil for an extended period. But again, it's not like there's an easy off ramp to Iran at this point. Now that you've taken out the leadership and both sides have kind of dug in, so we'll see.
All right. Thanks for that. And then, Chris, I think this one's for you. Michael Saylor doesn't even acknowledge the Bitcoin price crash. Is that discipline
Of course not.
conviction or an inability to adapt? At what point does diamond hands become bag holding with better marketing?
Ooh, wow, good question. Well, you have to be a permable if you're the largest holder of the asset, largest whale or in the top 10, right? Like, if you are Michael Saylor, no other option than to be a permable. So, I don't know. I think a better strategy for the average person is to actually think about cost basis and to buy when prices are down. But if you have a guy or a company or a treasury or a whale that says, I'm only going to buy if prices are down, then that is kind of going to help drive prices down. And that's not necessarily a good thing. So if you are the largest holder, you have to buy no matter what. If you're a small fry like me, where I just view Bitcoin as like a bull, right? Like a big animal, a big fat bull, and I am a fly buzzing around it, picking off little bits of food, which can be meaningful, but I'm not going to change the direction of Bitcoin. Maybe back in 2013, some of my comments would move price, but nowadays, not at all. And so Michael Saylor has to be a permable, and that's why he's always posting those tweets where he shows the yellow dots no matter what price does. So is it rational? If you're him, yes. If you're an average person, it's probably not going to get you the best cost basis. Do you guys agree, disagree? Any other
Let
thoughts?
me ask you. Let me ask a question here to you specifically on this. Like the value prop, the thesis around Bitcoin hasn't changed, right? Like nothing's fundamentally changed here with Bitcoin. Yes or no?
No, if anything, the fundamental picture for where Bitcoin sits in the world and what role it's going to play, it's only getting stronger.
Right. That's kind of what I was trying to get to. Is it does the risk reward on Bitcoin right now, I think intrigues me, considering when we look at gold and when we look at where the indices are, right? I think a lot of people are going to start to see that, and nothing's actually changed. The investing thesis hasn't changed. So I guess what do people want him to be doing? Like,
Yeah,
I
no, I
think
mean, I think I think if you're a Bitcoin bull, then part of the strategy is you want to accumulate more Bitcoin over time, right? Which I do. And I should also clarify for anybody that doesn't know me, like I've been in the space since 2013 and I came into the space as a trader. I didn't really understand or think that Bitcoin was going to be $100,000 or be the best, hard money asset of our generation. It's turning out that that thesis is playing out. And so my even opinion on it has evolved over time. And so, yeah, I want to stack more sats over time, but I also care about drawdowns. And like, I feel what it's like when Bitcoin falls 50%, like that drawdown is very real and tangible and it emotionally impacts people. So that's why I associate with the behavior of individual traders and investors more than I do with like Sailor. That makes sense.
And yeah, and I think Sailor, Sailor has is trying to take a very long term view, and again, he believes, I think that that Bitcoin has a path to a million plus, 10 million plus in the very very long term, and so he sees the short term as just sort of noise, and like, of course, you gotta survive the short term, and like they still have convertible debt, they're trying to get away from convertible debt, but they still have some on the balance sheet, so they got to get through the end of the decade and make sure that debt gets paid off or gets refied or gets taken out with preferreds. But ultimately, he's trying to build a structure that's going to like survive long term. And there's a lot of misunderstanding about that structure, frankly. And like I did a video, and he's probably like sick of trying to address those things where people are like, he's going to get liquidated at X price. It's like, no, that's not how this works. And so like he like yeah, he is like taking that position when he goes on a podcast that like, look, like everybody's really short-sighted and stupid, because a lot of them are stupid. A lot of people are saying stupid things that aren't factual, but also, like I said, he's also taking a very long-term view on it, and his sort of vehicle, or his sort of idea for how he's managing it along the way is very different than like your average person who's going to have a lot more constraints in the short run. But okay, putting all that aside, I actually have like kind of an interesting thought experiment on Bitcoin and gold that I was thinking about over the last couple of days.
Cool.
So, gold has the advantage of a whatever multi-thousand year history of holding up against debased money and being like a store of value. And so that's not nothing, right? Like there's something there, and it's clearly been something that has helped drive the price lately. However, when I think about like the future, when I think about all the stuff we're talking about, AI agents, and in a world that gets increasingly digital and full of robotics and agents and things like that, I'm like, what is the value of an inert shiny rock versus something that's digital? Like, what is gold's X402 protocol, right? How is an
Right.
agent going to transact in gold or accumulate value in gold? I guess you could say maybe they do it in paper gold in GLD ETFs or something. Maybe they do. But like when I think about the future, if we are going to have a lot of like digital intelligence alongside us, it seems fairly obvious to me that like crypto, whether it's, I don't know, Bitcoin or Solana or some other future thing, whatever it is going to take share from an inert shiny rock. Like I'm just like, I can't imagine a world 50 years from now where we have a ton of digital intelligence where an inert shiny rock is preferred over something that's got, that's digital native, you know? So I don't know. That's
Dude, I'm
another
so
way of
glad you made
saying,
that point. I mean, I 100% agree. I mean, think about what these AI agents are already doing now. They're transacting in Bitcoin and stable coins primarily. I want to say it's like 80 to 90% of what they're currently transacting in is a combination of stable and Bitcoin. And yeah, you're right. They're not going to send physical rocks through human I don't know. Maybe humans just become like shiny rock carriers for the AI bots.
Shave a
No,
little off.
yeah.
you make an
Uh,
interesting point about stablecoins, though, because on that, like obviously a lot of the volume is in stablecoins, but that's because a lot of agent wallets are just like transferring funds really quickly. But eventually, when agent wallets get big enough, they're going to need to have something that holds its value versus like fiat currencies. So I think over time, actually, we could see stablecoin holding shift towards something else in agent wallets. But again, that's a very long term view. But it's just something else I was thinking about.
Yeah. One more point I want to share is um, Saylor was getting quoted today saying there's not enough Bitcoin for everyone, and it's absolutely true. Like we're only a few days from minting. I think it's still a few days away minting the 20 millionth Bitcoin, and there's only ever going to be 21 million, and that's coming over the next 100+ years. So basically most of the Bitcoin is already out there. And I said, yeah, Saylor's right. There are about 8 billion people on the planet, allegedly, and 20 million or 21 million max. That's like a fraction of a Bitcoin per person. And I just asked how many millionaires there are in the world. ChatGPT just said about 60 million millionaires in the world. So there are more millionaires than there are Bitcoin. So if you are a whole coiner, you are going to be in the minority of people forever. Like that's pretty interesting, and that's a finite number. And there's more gold coming out at a larger stock to flow ratio. So yeah, I don't know, man. For those reasons and the digital economy, like Trav, I agree with you, man. Like the long term, if you think long term, this makes sense. But the thing that I don't want to forget is the very real world implications of, like you said, surviving the short term. And for individual investors, that means not getting blown up on margin or not freaking out and panic selling the lows, which again, it sounds so easy to not get caught up in that trap. But I've seen so many Bitcoin OGs do that in bear markets because they've got most of their wealth in it and they can't sleep at night seeing their net worth go down 70-80% or more. So that's where diversification and position sizing and all the shit we all have been talking about for a decade plus comes out, and it's very important. But long term, yeah, Bitcoin's it.
So it sounds like Michael Saylor not acknowledging the crash is just his conviction. Same old, no change in the investing thesis. That's what it sounds like to me.
It's his conviction. And look, if Saylor gets bearish, the market's going to absolutely implode.
True story. And he doesn't want that. He'd be in deep
Of
doo doo.
course not. Yeah.
Okay. Great topic. Last question. How are you handling the volatility in the markets? I keep hearing conflicting advice. DCA through it, raise cash, buy the dip, sell the rip. Can each of you tell me specifically what you are doing with your money right now, not what you think I should be doing?
I'm hedged short Bitcoin. I'm still net long, but I have a short, which means the lower Bitcoin goes, the more cash I make, fiat cash to buy back lower. I'm diversified. I own some shiny rocks. I own some stonks. I own some real estate. I own some startup equity. Right now, Bitcoin is well below 50% of my net worth. It at all-time highs, it goes above that, and then I sell some. Um, During bear markets, I short, I buy dips. Everything I do is to raise more fiat to buy more Bitcoin lower. That's my strategy. What about you guys?
I'm a big DCAer in especially when there's like really bad sentiment and deep corrections. And so, yeah, I was actually DCAing to Bitcoin here in the last month or so. Part of that is because I didn't have a full position in my public 100K portfolio. So in that portfolio in particular, I was DCAing as Bitcoin went lower because I had a fairly small position. So I've been building up that position with the knowledge that it could very well go to, some confluence areas like in the 50K range or perhaps even lower, right? And so, yeah, taking a long-term view and definitely doing like a slow DCA approach there. Same thing in stocks too, to some degree. But what allows me to do that is like I also sell into euphoria. Like I had a heavy cash position late last year, early this year, because I take profits on the way up. Like there's like even on stuff that's in a hot sector, like my Micron position last year, like I was taking profits all the way up. And if I miss the last 30, 40, 50% of that run when it's in the truly parabolic mode, I'm okay with that because like I'm taking profits out and I'm adding to my cash balance that can then be deployed when the sentiment shifts. So basically, like my whole thing is always like take advantage of fear and greed. It's that simple. It freaking works. It's worked my whole career. I sell into greed. I sell into parabolas. I sell into the markets when people are taking stocks, even individual stocks to silly levels. I raise cash, and then when dips come, I have cash and I buy them. And I don't just sit on the sidelines forever. Now, there's probably an approach that works a little better than my approach on DCA, like waiting for, stocks to base or waiting for assets to base or show some sort of like, reversal. There are momentum approaches like, using shorter term moving averages, for instance, that would probably improve my cost basis on some of my DCA. But you have to find the approach that works for you. And so like, the way I do it is not necessarily the right way, but yeah, I've been buying the SaaS blood even because I think there's some values there that, that came about because everyone was treating that sector so bearishly all as one trade when obviously when there's hundreds of companies in the sector, there's going to be like some that perform differently over time. So yeah, there's probably going to be a blow up in credit at some point in the next 2 or 3 years, private credit, there's all this weird stuff, right? Like there's going to be, maybe we'll get a 10 or 15% S&P correction. Like inevitably we're going to have stuff that freaks the market out. We're going to have like deep dips on stuff. So yeah, my approach is always just don't be over levered. Sell when you've got gains, like when you hit price targets that you're comfortable with, and redeploy whenever like everyone else is shitting their pants. It turns out it works.
Yeah, it does work. This has been a pretty fun time. I myself, I've been harvesting gains and also selling some underperformers, some losses, to just generate cash in the portfolio. So I've been, sitting. I already bought some things that were in the SaaS apocalypse sell-off, but I'm looking to deploy more capital. So I've been in cash generation, reallocation of the active portfolio phase. And I'm still, continuing to do that even today. I'm waiting for some things to pounce on, especially if we break down in the S&P 500. So that's what I've been doing is reallocating, rebalancing, cleaning up the active portfolio. Because there's a lot of opportunity out there right now, a lot of stocks in deeper drawdowns, and that's an exciting time to take advantage of high quality opportunities. You've got
Well said.
You've got Microsoft down a ton, Amazon down. We're talking Mag 7 stocks that have had, decent corrections and many, many, many more quality names that are giving great entry points. So that's what I've been doing.
Good stuff. Well, yeah, I think we covered a lot of really good things today. The big thing, I guess, to just kind of stay dialed in on is Iran, oil, Bitcoin, gold, stock. I mean, basically everything. Have you guys seen all the memes going around monitoring the situation?
Yeah.
We're all like this, like.
Yeah. It's I don't know. I've I've been, I think, doing a pretty good job of balancing like watching and managing positions and also going down the AI rabbit hole with these agents. But I'm looking forward to the point where like the agents actually save me time instead of like costing me dozens of hours a week. So we'll
Yes.
see.
You mean
Yes.
they need a human to get them going?
Oh yeah,
What?
dude, it's still janky. Like OpenClaw is not ready for your average like consumer. It's a lot of just recursive improvement, error fixing, figuring out. Like I enjoy it, which is why I'm doing it. But for anybody that's like I not ready to jump into it fully, like you wait a couple of months and it'll be way, way, way better.
Who has the time?
Exactly.
I think it is
So
really
I
important for people to carve out time, though. Like increasingly
mhm.
especially this year, I think it's really important people carve out time to actually like play with the tools and start to like develop some expertise. Cause like, yeah, that's how you can make yourself even more valuable, especially if you're in a white collar job, is be an expert on that stuff.
Yeah, I did see a funny tweet. Some guy said something like, to fully like understand and be able to work with these AI agents, you have to be unemployed. So it's like if you lose your job to it, okay, then you'll have the time to understand it.
I do
Yep.
want to give a warning. I've noticed, financial planner Nikki coming out. I noticed that Open or Chat GPT was giving incorrect tax information, like obvious stuff that's not hard. So I don't know what's going on over there, but if you're getting tax advice from Chat GPT, be careful.
I mean,
Keep
yeah,
using
people
that
forget
brain.
a lot of the frontier models that are out like coming out now were trained 6 or 12 months ago. And so and some of them can obviously access the web especially if you ask them to explicitly, but a lot of times what you're getting in the default answer is from something that was trained on 6 or 12 months ago.
Yeah, I
Good
was
point.
like, man, major fail, major fail. But yeah, just be
Well,
careful.
we still need humans for now.
Mhm.
Yeah, we still need our brains for the moment.
Yeah. Awesome. All right, guys. Well, we can go ahead and wrap it up there. Thanks for the questions, and Trav and Nikki, your insight is always awesome.
Same, brother.
And yeah, man. Let's see. Go to wetalkmoney.com, leave a question for the show. Make sure you're subscribed to the audio podcast and the YouTube channel. And yeah, we'll see you next
Oh,
time.
real quick announcement for
Mm-hmm.
those of you in the community, or if you're not in the community, get in the community because I'm doing a class next Friday on rebalancing your portfolio through all this chaos and finding the
Cool.
opportunities. So
We'll
join
link
us
that
for
up
that.
below as well.
Yep.
All right. Thanks, guys. See you next time.
Cheers.